Welcome to our quarterly market update from John Giordani, the Chief Investment Officer at Planning Solutions Group. One of our key themes has been political risks and the impact on markets. The June vote by UK citizens to leave the European Union, or Brexit, certainly fits with this theme. Let's jump in and take a look. The outcome of the vote was quite a surprise since both polls and odds makers showed the Remain vote was ahead just prior to the referendum. Investors hate uncertainty and usually respond by hitting the sell button. So what does this mean? This is the first time the European Union will have to deal with a country wishing to depart. This is not a legally binding vote. If the UK chooses to exit, the process will likely take more than 2 years. There are many issues to confront, and no one has all of the answers. The UK is one of the world's largest economies and accounts for approximately 4% of global GDP. They are headed for a recession. Many experts believe the hit to other economies around the world will be minimal. The larger risk is that of contagion. What happens if another country like Italy or Spain wants to leave the European Union? Risks do remain, and we will be monitoring Italy's constitutional referendum as we head into October of this year. However, at this time, we do not foresee another global financial crisis like we experienced in 2008. Safe haven assets like gold and government bonds have seen massive buying interest since the Brexit vote due to investors' fears. Events that significantly impact markets have occurred many times over the year. The chart at the right is from Putnam Investments. It lists 18 different crises and looks at market performance during and after the incident. Examples include the attack on Pearl Harbor, the resignation of Nixon, the 1987 stock market crash, and the collapse of Lehman Brothers in 2008. I encourage you to pause the presentation and review this chart. You will see that prices are negatively impacted in the short term, but recoveries do follow. Asset prices rise again, and all is well. In fact, historically, the U.S. stock market on average has gained double digits annualized when looking back 5 or 10 years after the event. While we cannot assure prior market behavior will duplicate in the future, historically the data shows that selling after the fact has been a bad move. As we communicated to clients shortly after the Brexit vote, do not let fear and greed hijack your portfolio. The silver lining to market sell-offs is they create opportunities, and we believe we have found a couple that we will discuss later in the presentation. One last point on Brexit. Larger dynamics are in play. After the 2008 financial crisis and global recession, many countries have been in a state of economic malaise. Most people feel worse off than they did a decade ago. Growth and wages remain stagnant. We talked about this in our last market update in April. Financial crises like the one the world experienced last decade take a very long time to heal. Shown at right is a chart from BlackRock Investments. It compares the current recovery for Europe, Japan, and the US to past recoveries after a recession. As highlighted, each economy's recovery is much weaker than the typical recovery. Both Europe and Japan are stuck in the basement. Facing this, the natural reaction is to circle the wagons and move inwards, towards an increase in populism while moving away from globalism. We are seeing this right here at home with the record political polarity between the two parties and the popularity of anti-establishment candidates like Donald Trump and Bernie Sanders. Looking at the government bond markets, central banks have been in a massive easing mode since the financial crisis. Risks of deflation have scared the powers that be. Weak economic growth and wage growth have driven yields to minuscule levels. The chart from JP Morgan displayed here demonstrates this. In gray, the percentage of global bonds around the world yielding less than 1% is displayed. Currently, it stands at 74%. In blue, bonds with below 0% rates are shown. 10 years ago, most government bond yields were in the mid-single-digit range, and now over 1/3 of the government bond market have negative interest rates. This means that those buying these bonds are paying a penalty for safety. They only want most of their money back. Never in my life would I expect this to happen. But larger forces are in play here as well. Demand is coming from central banks buying bonds as they continue what is called quantitative easing. In addition, regulatory requirements require certain financial institutions to buy bonds regardless of the price or yield. Responsible savers are the ones being hurt the most. To generate income is a challenge, and one that now requires taking a lot more risk. The demand for income has driven the yields of most asset classes to well below average levels. At least here in the U.S., our 10-year Treasury bond is still in positive territory, yielding 1.5%. U.S. equities and real estate offer a little bit better in terms of income, but also with significantly more volatility and risk of loss of money. Over the past 9 months, we highlighted that we believed both corporate bonds and high-yield bonds offered an attractive risk-reward opportunity. Investors had unfairly punished credit-based bonds last year. Since then, we have seen a significant rebound. On a relative basis, we still believe they are attractive. High-yield bonds still pay over 7% and historically have been much less interest rate sensitive. This offers some protection against rising interest rates. Before investing in this asset class, talk to your advisor. Professional management is a must as risk of loss is high and credit research is very important. We also believe the preferred stock asset class is attractive. A preferred security is somewhat of a hybrid between stocks and bonds. Currently, the index is yielding near 6%. Supply-demand fundamentals are positive, and many of the issuers are in good financial health. Another reason we are interested in preferred stocks is that historically, they have been a pretty decent diversification asset class. Shown here is the correlation of preferreds to other asset classes. A perfect linear relationship exists if the correlation is 1. Correlations near 0 indicates no relationship exists. Preferreds have almost no correlation to U.S. government bonds and only moderate correlation to other asset classes like stocks, real estate, and corporate bonds. They behave somewhat differently, which historically has provided diversification. This is another asset class where we recommend using professional active management. Research of the health of the underlying issuer is important. There are several nuances with this asset class, and investing in preferred stocks is not without risk of losing money. Turning to look at the stock market, the most popular index, the S&P 500, which is a representation for U.S. large-cap stocks, just recently hit an all-time high. However, looking at the prices of many smaller companies, they are down significantly from highs, which has led to them being in a stealth bear market. A group of the largest companies in the U.S. are doing well. That's holding up the S&P 500 near highs. But it's not as pretty when you drill down and look at all U.S. stocks, not just the largest ones. Shown here, we look at how many companies are down 20% and 40% from 3-year high prices. As displayed, earlier this spring, over half of U.S. stocks were down more than 20%, and over 1 in 4 were down 40% or more. The volatility surrounding global events and the collapse in energy and commodity prices has negatively impacted many company stock prices, and this is not only in the U.S. Most international stock market indices are also in correction or bear territory. As an investor, you need to realize that pullbacks, corrections, and bear markets are part of the investment cycle. Markets do not go up each and every year. Looking back in history, there are many years where new highs do not occur. From a longer-term picture, the past 5 years, the only game in town has been the U.S. large-cap stock market. Being diversified has not been beneficial to a portfolio. U.S. stocks have doubled, while Europe and emerging markets have been left in the dust. Many investors are asking the question, is it time to sell the underperforming asset classes and buy more of what is working, meaning buy U.S. stocks? This is the point where human nature and behavior may take over and can negatively impact your portfolio. Winners rotate, and after long periods of outperformance, underperforming asset classes may play a game of catch-up. Chasing winners and selling losers is usually buying high and selling low, the exact opposite of what you want to do. Let's take a look at the 2000 to 2009 period. U.S. stocks lost money over this 10-year period. Europe added nearly a 30% total return, while emerging markets were up over 160%. Think back to that last chart. After 10 years when U.S. stocks made nothing, what would have happened if you sold U.S. stocks and chased the emerging markets sector? You would have abandoned U.S. stocks, an asset class that has since doubled, and bought an asset class, emerging markets, that hasn't made any money since then. Now, in the current market, would you possibly want to repeat that mistake? Historical studies show the average investor makes mistakes like this time and time again. Previously, we have shown the Dalbar study of the average investor's portfolio. Over the past 20 years, it has barely kept up with inflation. This is due to falling victim to behavior, including buying high and selling low. Speaking of international stocks, here is a chart from BlackRock of the valuation of U.S. stocks as compared to overseas markets. We understand there is a lot of fear of investing overseas. Brexit, China, and the commodity price rout are just some of the worries. However, the value of many international markets is significantly cheaper than U.S. stocks. The valuation of stocks is the first column. As displayed, many other international stock markets are cheaper on valuation metrics. So perhaps the bad news is discounted by the markets. BlackRock, one of the largest asset managers, believes so. Their opinion is opportunities look more attractive abroad. We tend to agree with their assessment and have positioned portfolios accordingly. The sell-off after the Brexit vote provided an opportunity for investors to buy at lower prices. As we make our way through the back half of the year, we expect volatility to remain above average. The U.S. presidential election is quickly approaching. Historically, U.S. stock markets have not done well in year 8 of a sitting president's tenure. We are not out of the woods yet with the international issues that we have previously discussed. We continue to favor higher quality investments for the core. However, as opportunities present themselves, reposition portfolios accordingly. Over the past 12 months, there have been several sell-offs in various asset classes that allowed us to do just that. Today, we discuss both preferred stocks and international equities and high-yield bonds. Most importantly, don't abandon your plan. Modify it when there is a change in circumstances that warrants an update. There will be both good and bad markets ahead. Letting your emotions take over is the single largest mistake investors make. Maintain a diversified portfolio, rebalance when needed, and understand how much downside risk is in your portfolio. These are successful investment principles that have worked over time. That wraps up our current market update. If you have any questions, contact us at the number below. You may also access more information, including timely articles and account information, by visiting our homepage. Please watch for another market update in October. Thank you.